Right, we are joined by Brooke Thackray, research analyst at Global X. Among other things, he's a keen observer of seasonal variations in the market. It's great to see you, Brooke, as ever.
Thank you.
Maybe we'll put up a one-month chart or a chart for May showing the TSX and the S&P 500. May usually not a great month in the markets, but it's been pretty good this year.
Yeah, well, we've seen a record for the S&P 500. If it continues, it'll be the best May since 1990. So this is a bounce back that we've seen really on the whole tariff situation. This is a TSX composite. TSX was up as well. This is really the continued reaction to the tariff situation, that investors still believe that the tariffs are going to resolve fairly amicably down the road. And so we've seen the markets run. We've seen a lot of short covering as well. There's a lot of shorts in the market that got covered and a lot of FOMO. So we've seen the markets go up higher.
Logically, I guess people bet against the market in a trade war.
Because longer term, you look at a trade war and you say, well, if there's a trade war going on, this is not good for global growth. So we saw some bets, but they got unwound, a lot of them.
We were looking earlier to the best sectors in Toronto this year. Materials leading the way. So year to date on the TSX, hardly surprisingly, with gold hitting record after record and the gold miners going up.
Yeah, well, gold miners, if we look at gold miners so far year to date, and I know in the States they're up around 48% or so. I mean, that's a huge move. So I think it's around 70% of the index in the sector index for Toronto or Canada in the materials is in gold, production related to gold. So that's going to have a huge impact. And then we have other metals and mining as well. So there's no surprise there, just based upon how well gold has done.
There's a one-year look at the materials index. Of course, I'm curious, why isn't every gold miner not declaring a massive special dividend for shareholders?
They've got, that's interesting because their cash flow is amazing. And it's like everybody's looking at this cash flow going, gold miners, gold miners, gold miners. I think they're just trying to be a little bit cautious here at this point, I guess, to see what happens on a go-forward basis. But yeah, they have been generating huge amounts of cash. Maybe if one does it, then you'll see some others follow along. Yeah,
Lundin Gold, if I remember correctly, has announced one. Yeah. I suppose they buy back stock.
Yeah.
Are you a fan of stock buybacks generally?
Well, really, at the heart of it, no. I'll tell you why. It's because that money is being put, could have been gone into further expansion. But if there's not expansion opportunities, whether it's, let's say, in your manufacturing or whatever it is, then it's not a bad use of money. But I prefer to see companies invest capital in CapEx and for miners to invest in projects on a go-forward basis rather than buying back stock. That's just the way I see things. But if there's not good opportunities, then yes, buying back stock, you can't help it.
And the consumer discretionary sector has been flying as well in Toronto. Of course, we have a narrow market and just one stock can distort that. And Dollarama hitting record highs has been a big part of that.
Yeah, I mean, we've seen some real interesting facets as far as the consumer discretionary goes in the States and Canada as well. But in Canada with Dollarama, I mean, that's had a huge impact as far as that goes. And that's really company related. You know, they've done extremely well. But that's not a reflection. If you take a look at the broader market sector in the States and consumer discretionary, like Amazon's done well, obviously Tesla's done well. But we're seeing cracks with other consumer discretionary stocks now. And the tariffs are starting to weigh on them as well.
Once again, the telecom stocks have suffered this year, including our parent company, BCE. That group has been among the weakest.
Yeah, if you look at the telecoms, I mean, they've just been this downward trend, and everybody's saying, well, we're going to wait and see what happens as far as the bottom here goes. We've seen competition come into the market, a lot of questionable things as far as on a go-forward basis for Canadian telecoms. And investors said, look, we can just be elsewhere at this point. And so it just hasn't had that excitement. They haven't seen the catalyst to get them out of the funk yet.
And then also energy hasn't done very much now. Energy, of course, is a very broad category. It's not just oil and gas producers. It includes pipelines and also uranium names. So that has been something of a laggard this year as well. Not surprising with weak oil.
Weak oil, and here we are talking about OPEC again, talking about increasing production again in weak oil prices. Here we are just around $60 WTI. Wouldn't be surprised to see oil go down to the high 50s here. So yeah, the energy sector has been a laggard overall as well. And uranium, if you talk about the uranium sector, I mean, lots of news there. We did see the uranium sector have a strong bounce the other day based upon Trump's executive orders coming out. But we've seen some weaker trends earlier this year as well for that sector. And that sector's, I call it the Rodney Dangerfield of the investment business, because it never gets any respect and it gets us these little blips. Longer term prospects for uranium are fantastic. We all know that because you just do the math on the supply-demand imbalances, but it's just investors are just focusing on other aspects of the market at this time.
And of course, we've got a lot of hype about these small modular reactors, but I think it's going to take years before those things are approved because they're breaking new ground.
They're breaking new ground. So the first SMR for the G7 was actually approved in Ontario, actually.
Yeah, that's right. Using U.S. technology.
Right.
But anyway, yeah.
Yeah, I mean, that's the problem with uranium. It's these, you're looking at 10, 15-year build-out on some of these things, and SMRs are much, much shorter. I mean, I don't know what the Chinese build-out time is. I'm sure it's faster.
Oh, yeah.
They build everything really fast.
Yeah.
So that will help the uranium companies overall because they're really building a huge amount of nuclear facilities as well. But yeah, you're right. There's a lot of hype around that, but it's going to take time to really have an impact. And so what we're seeing right now is we're seeing investors play a game of chicken because they're saying, well, this is going to take time. As far as working its way through the system. Yes, there's a deficit of uranium. We don't have enough. And the problem's going to get worse and worse over time. But we're still going to, it's down the road. They're just ignoring it. So, but it will have an impact at some point.
I forgot to ask you, just remind us, so May is usually a lackluster month, and then we get into seasonally, we get into the summer doldrums for the markets in June.
So June tends to be a weaker month of the year. It's one of the weaker months of the year for sure. Over long term, on average, maybe it's different this time. We saw this strong May, this record-breaking May for the S&P 500 so far. I think we're actually going to see a little bit of softness in the market in June coming up. There's going to be a reaction to this. I think investors have become overly excited about the tariff situation, going, hey, it's all going to be solved. We're going to go down to single digits or something, and it's going to play out over time. We're going to be fine. And there's a lot of optimism around that. I don't think that's the situation at all. I think the terminal point of tariffs is higher, where the tariffs end up, is higher than what investors are pricing in right now. And I don't know when that realization is going to be.
The ultimate tariffs will be worse than investors think.
Yes. Because I think they're pricing in, like right now, the effective tariff rate in the States, according to the Yale Budget Lab, is 15.4%. That's right now.
Okay.
And everybody's pricing in that tariffs are going to really go down to like single digits, type of thing. And they're saying, well, it's all going to solve itself at a much lower level. We're not sure where it's going to be, but it's going to be much, much better from where it is today. I wouldn't be so confident of that. I think the tariffs will come down, but they're still going to have an impact on global growth and shipments. And I think there's going to be some wars coming up here a little bit. We've seen a lot of pauses, placating back and forth, but I don't think it's going to be quite as smooth as what most people expect.
And the U.S. public presumably won't be delighted if it contributes to rising prices.
No, I mean, the tariffs really aren't, my belief on the tariffs they aren't good for anybody as far as the production goes, efficient production around the world. But yes, I think initially what you're going to see, though, is you're going to see the companies actually picking up the cost of some of the tariffs initially. Their profit margins are at record highs right now, so they can do that on an average basis. China has been absorbing some of the costs as well. I mean, when they went to 145%, that was just a shutdown. So China's doing that. The consumers will be picking up some of that. There's absolutely no question. And over time, they're going to be picking up more and more of that tariff bite, and eventually they'll be picking all of it up when the competition really straightens itself out here.
I mean, I guess I'm an old guy. Advertisers don't want me. You can't change my mind. But with higher prices, I'm just not buying stuff anymore.
Well, you're going to substitute some things.
Yeah.
Right? You're going to say, if beef's too expensive, or buy pork, that traditional substitution. And you're going to go from, it depends, you'll go from products to services. So I think it's
experiences.
You're going to do some substitutions. I think you're right. That initial sticker shock when you go into the store, if prices rise over time, for those products that have tariffs on them, you're going to say, well, I'm not going to get that. Yeah. But down the road, you're going to buckle a little bit. It's like, they raised the price of pizzas or something. Like I went in to buy pizza for the family the other day. I go, my goodness, I can't believe how expensive this is. It's a pizza, for Pete's sake.
Yeah.
But a few years ago, it wasn't that bad. But at some point, you just cave. And you go, I'm not making the pizza. I'm just going to buy it.
Yeah, well, I was talking with a friend. A banh mi Vietnamese sandwich on a baguette in Toronto is now $9 plus. And my buddy, who's old like me, could remember when they were $1.50.
And is he eating them, though?
They're pretty addictive. Yeah. Brooke, thanks very much.
Okay, thank you.
Brooke Thackray, research analyst at Global X. Canadian